Hey guys, my name is Nicolette Mashile. I am also known as your financial bunny. So today I want to talk a little bit about some taxes that are going to be due on investment or savings or policies or products that you may have. This is very important because it's always the big shock that a lot of people never ever expect. Before I get into this video, please do remember none of my videos constitute as financial advice. If you are, however, looking for financial advice, please do speak to somebody that is certified and registered with the FSCA. So you guys will remember a couple of years ago, we started a property investment company, or it was rather a stokvel when we started. I think it was back in 2017 when I suggested that we come together as a group of people, we use the power of numbers and we buy properties together, or at least invest in the property sector together, right? A couple of people came together, and by the time we hit 2019, we had saved some money, and then we were ready to register ourselves as a juristic person, and we went to the CIPC to register Mikateko Property Investments Pty Ltd. Right. So after doing that, we then invested, and I say this very intentionally because we only invested after we actually registered as a CIPC, at CIPC, right? So, okay, now we invest in a contractual note that turned into being an endowment plan that none of us knew, but it's fine in any case. Okay, sharp. Now that endowment plan or that endowment product then matured this year, April. So once it matured, most of the guys in the stokvel were like, actually, we want our money and we want to actually withdraw our money. Okay, guys, let me tell you, we had this journey of trying to withdraw the sum of amount of money. What we thought we were going to get versus what we ended up getting was a huge difference. There was what we felt was a bit of a discrepancy, but what we found out was that we were supposed to be paying capital gains tax on this investment that we had actually made. And the capital gains tax that were due was so big, it was actually so disheartening when we found out how much we would end up actually getting at the end of the maturity of the actual investment. So that's why I wanted to do this video, because I think a lot of people, when they are choosing investments, many of us don't take the tax portion of it, or the tax that is going to be due on those investments, into consideration, so that we can actually invest in the right type of investments and savings products. So the first one is, of course, capital gains tax. And the reason why I was very intentional about saying we only invested after we became a juristic person is because SARS looks at a juristic person and a natural person very differently when it comes to capital gains tax, right? As a juristic person, you are going to pay, or 80% of the gain is going to be liable for tax purposes. And as an individual or a natural person, only 40%. But what is the gain that I'm talking about? So think about it this way. You buy a property at 100,000 Rand, you sell it at 150,000 Rand. That 50,000 Rand is what we call the gain. So that's the difference between the amount that you paid for the actual property and how much you sell the property at the end for, right? So the 50,000 Rand is what then is liable for tax purposes. But then, if you're an individual, SARS will only look at 40% of that 50,000 Rand. Whereas if you are a company, they look at 80% of that. So it's very important to also think about what type of structure you're going to be taking your investments out in. So a lot of people ask me, why are you not buying your properties under your business instead of your name? I didn't know it at the time, but right now I'm like, oh, I'm grateful, because actually, if I do decide to sell them and there's a taxable event that happens, I won't be liable for it 80% because I bought them under my actual name. So it's very important to understand capital gains tax, and it usually is paid when you're buying an asset that when you sell off at a difference, right? The next one that you need to remember is what we call dividend withholding tax. Now, dividend withholding tax is a sneaky one, because a lot of us don't even know that we actually paid the tax. Why? Because the companies that you probably invested in that do pay dividends pay this off to SARS on your behalf. So it's something that you don't actually have to worry about. Just that most of us, we see the dividend coming in and we're like, oh, okay, I got a dividend payment from this company that I've bought shares or I hold shares in, but you don't realize that you've actually paid tax for that dividend. So essentially, that dividend withholding tax is currently 20% in South Africa. So basically, if you are going to receive a dividend of 1,000 Rand from a specific company, you will only get 800 of that money into your bank account, or into the account that you have nominated as your dividend receiving account, and the 200 will be paid to SARS. As I said, the companies will pay that off on your behalf, so you don't really have to worry about that. The next one, which is probably one of my favorite, and this is the one that trips a lot of people, because I know a lot of young people that have amazing amounts of money in deposit accounts, 32-day accounts, usually in bank offered products where you are earning an interest. Now, it's called income tax or it's called interest tax. And the problem with this one is, as I said, a lot of people have different types of investments or different types of savings accounts, high yielding interest bearing accounts where they're earning interest. And this is the one that trips a lot of people over, because then they go over the threshold. So every year you are given an exemption of 23,800 as an individual who is below the age of 65. And if you're over the age of 65, you're given an exemption, an annual exemption of 34,500. Right. So you can get interest up to 23,800. The moment the interest goes above that, then you need to be paying tax on that interest based on your bracket, the income bracket or the tax bracket that you are in, right? So it's very important to understand this, because a lot of people keeping like R1 million in a savings account at a bank, and they are earning like 8,000 Rand every single month. In 3 months, you've killed that 23,800. Literally in 3 months, you've killed 23,800, which means that the rest of the money that you're going to be earning is liable. It is liable for tax. So it falls as part of your income. So you need to be very wary of that, because you're going to pay tax on it, right? The next one is tax on retirement savings. Now, I bring this one up very intentionally also because remember, when you are contributing to a retirement product, right, except in most cases for the RA, because the RA, especially if you are doing it as an individual, you are probably going to contribute to an RA if you're doing it on your own after your money actually hits your bank account. So you are actually not contributing to an RA with tax-free money. You're actually contributing to RA with money that already has been taxed. But for many people who are part of a retirement product, pension fund, retirement funds, and provident funds, your money is deducted. Your pension money is deducted before before it is taxed, right? So your employer will actually take that money out of your bank account, and you will contribute to the pension fund before it is taxed. So it's up to 27.5% of your taxable income that you can contribute towards retirement, or I think it's up to 350,000 Rand. That money is tax-free when it gets invested. But when you come to retirement years and you want to withdraw that money, it is of course then liable for tax purposes. First and foremost, we know the first 550,000 Rand is not liable for tax, but the rest of the money that you're going to be withdrawing is going to be liable for tax. The nice thing is that in retirement, there are different tax tables that you're going to be working with. So it's not the same tax tables that you are currently using right now in your everyday life. So remember that the money you're contributing towards retirement is tax-free. So when you get into retirement, there will be a tax that you are needing to pay. The next one, which is shouldn't necessarily be part of this list, but is the tax-free savings account. Remember, on a tax-free savings account, all of the money that you're contributing, the earnings that you're going to be making, the capital gains, the interest that you're going to be making, if there's dividends that are being paid, if you're taking out a tax-free shares account, you're not going to pay tax on it. However, there is a limitation. It's 36,000 Rand per annum and 500,000 Rand per lifetime. Any amounts that you pay over and above those limits annually or in a lifetime are then subject to tax. So it's very important to know this, because a lot of people think that they want to be clever, and in a financial year, they want to go past that 36,000 Rand, and then they think that they're not going to get paid, they're not going to get charged tax. Anything that goes above the 36,000 annual or annual amount that is allowed, you're going to pay tax on it. The last one, which is the new one that has just now come up, and I bring it up because I think it's important, is monies that you're going to be withdrawing from the two-part retirement, as part of the two-part retirement system in your savings component. So if you are going to be withdrawing from your savings component, remember that money is going to be liable for tax purposes at your marginal income bracket or tax bracket, right? So, and also again, just to bring it up here, the current income tax table that you are working with currently right now look different from the tax tables in retirement. So if you just wait until retirement, you may even pay less in tax. And just a measure of caution. If you owe SARS, let's say you've done your taxes for the year and you find out that you actually owe SARS, and then you want to withdraw from your two-pot retirement, and I say, you want to withdraw from your two-pot retirement, it's really not your two-pot, the thing is not called your two-pot retirement. If you want to withdraw from your savings component as part of the two-pot retirement regime, you are going to find out very, 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 very in a very snacks and sus manner that SARS will first take their money before they actually give you the money that you are withdrawing. So if you owe SARS, for instance, 18,000 and your savings component gives you 18,000, SARS is going to quenya the whole 18,000 rand because you owe them money. So I just thought I should give you guys some of these taxes so that when you are thinking about investments, do ask the financial advisors and the financial experts what types of taxes you will be liable for in the investments that you are making. I want to speak about financial advisor fees because I'm still sour about this investment that we went in as Mikateko, but I think I'm going to leave it there for another video because the investment fees, guys, the financial advisor fees are wild. Let me tell you, even in an investment that is closed off, where basically you are invested in for 5 years and basically the advisor doesn't speak to you for 5 years, she's still got a right to charge you financial advisor fees. So be careful. Be very careful because it eats away at your investment. In fact, we found out that it doesn't just eat away at the money you make, it eats away at the original amount of money that you invested. So if you invested 10 Rand and every year for 5 years they charge you 1 Rand, it means that every year they're going to take 1 Rand. So you end up being left with only 5 Rand that you actually invested because the 1 Rand of financial advisor fees has eaten away at your original investment. I needed to say that. Somebody leave it at that. Okay, guys. I'll see you guys on the next one. Please do remember, before you go, none of my videos constitute as financial advice. But if you are looking for financial advice, please do speak to somebody that is certified and registered with the FSCA. I'll see you guys on the next one. Mwah.